Hi, Warren William here from Smartest Data. As a stock investor, would you like to discover ways to increase the returns on your stock portfolio and to maintain your investment strategy? In this video, I'm going to cover how stock options work and 2 simple strategies to discuss with your broker that could increase the returns on your portfolio. Let's go to the video and discover how this can be done. Okay, so let's get into this. Well, first off, you must have an investment strategy, and this can be implemented by using individual stocks or funds. For every position in your investment portfolio, including cash, you must have an investment strategy. For individual stocks, you must define an individual investment strategy based on the valuation that you've assigned for a stock. Simply put, this means what stock would you like to own, or why you continue to own a stock, or when you need to sell a stock. So let's cut to the chase. How do you make money? Well, you can issue options by writing or selling a stock option. As the writer of the contract, the premium paid on the stock option is paid to you, and the premium can boost your returns. The buyer of the option pays the premium and has the rights as stated in the option contract. The premium is paid in the currency of the underlying stock, and the number of shares covered by a contract is typically 100 shares. All this with limited risk to your investment strategy. Now, as the option is traded, the price includes the option premium because the rights of the option contract has been transferred to the new holder of the option. The price paid on the traded market is not paid to the writer of the option contract. That is gone. Options are issued out of the money, and the option premium has only an extrinsic value at that point. The price of the in-the-money option will have both an intrinsic and an extrinsic value. So let's go over an option contract. An option contract is a financial arrangement between the two parties, one being the seller of the option and the other being the buyer. The contract will have various clauses that defines the rights of the buyer and the obligation of the seller. Each contract will define and establish standard features of the option. These features will govern the contract. An option contract will define the underlying stock, what type of option, what is the price governing the option, being the strike price, how long the option will be enforced, the style of the option, American or European, and the settlement. The Black-Scholes model is used to calculate the premium of the option. Other parameters included in the calculation are interest rates and volatility. Okay, so let's look at the individual parameters of the option contract. First off, underlying stock. The underlying stock is the security that the option contract is defined. Of course, in the broad options market, the underlying asset does not have to be a stock or even a security. The underlying could be a stock index or another index, fixed income securities, a commodity, or an exchange rate between two currencies. So the option type. An option can either be a call option or a put option. If you are the buyer of a call option, you have the right to buy the underlying stock. The buyer of a put option gives you the right to sell the underlying stock. The strike price. The strike price is the stock price at which the underlying stock can be bought or sold if the option is exercised. This is the price predetermined at the time of the option contract is formed or written. The expiration date. The expiration date is the date on which the option contract expires. This will be the last date at which the buyer can exercise their rights. Post this date, the seller's obligations under the contract is terminated. Exercise style. So options are defined into 2 main styles, one an American style and the other European style. The distinction is determined by the possibilities as to when the option can be exercised. Now, an American style option can be exercised at any time on or before the expiration date, whilst the European style option can be exercised on the expiration date and only on the expiration date. Okay, finally on to settlement. The settlement of a stock option is by cash or the purchase of the stock, whilst the stock index option is settled by cash. Okay, making money by selling options. Okay, so now we understand all the parameters that go into an options contract. Then to value an option, we use the Black-Scholes model. The Black-Scholes model considers 5 factors to determine the value or premium for the option. The 5 variables include the underlying stock price, the option strike price, the time until the option expires, so 3 months for example, the risk-free interest rate, and the volatility of the underlying asset. The premium paid is how you will make money by selling options, and this is the price that the buyer of an option pays for the option contract. This price is determined by factors such as the current market price for the underlying asset, the strike price, the expiration date, the volatility of the underlying asset is important. The Black-Scholes model calculates the fair price of an option based on these variables, as this is the present value of the expected payoff at the expiration date, discounted at the risk-free rate. The model assumes that the underlying asset price follows log-normal distribution. Thus, the rate that it changes is proportional to its current value. Okay, so let's move on to covered call options. The seller of the covered call option must own or have access to the stock to cover the risk of being exercised. The key is that as an investor, you have determined the value for the stock. A stock price which achieved would be a price that you would be a seller of the position. Thus, your sell valuation corresponds to the strike price of the option contract. Therefore, when you sell the option, you receive the premium. If the stock option is exercised, you're obliged to sell the stock to the holder. This is what you were considering to do anyway. Or if the strike price is not achieved, you continue to hold the stock, it's below your valuation, and the premium is extra income. A covered call option is a conservative strategy, as the risk of the strategy is reduced as the seller has the stock to sell. Yes, the potential upside of stock price is capped. Okay, so let's go through a practical guide on how to implement a covered call option strategy. First off, you have to value the stock. This is a stock in your portfolio that you have valued and would look to sell at a certain price. This becomes the strike price of the call option, or nearabouts. Of course, the strike price must be above the current share price. It's a call option. The price must not be excessively above, because there must be a market for your call option. So this is a stock that you're near looking to sell. So what's the obligation of the seller? The seller of the call option is obliged to sell the stock if the call option is exercised. Thus, monitoring the stock's price must be done to understand the likelihood of the call option being exercised. At the expiration date, a stock price below the strike price means the option expires worthless and you will keep the premium. Okay, so let's take a look at bar chart, where I get a lot of my information, not only on options, stocks, indexes, ETFs, it's all in there. It's a very complete package. I'm a member of the Bar Chart affiliate program. If you'd like to subscribe, there is the link below in the comments, and I will get a little bit of a commission, and that does really help the channel. Okay, so let's take a look at bar chart. Okay, so we go through the opening page, and that'll go through a drop-down menu and all the information which you can get, which includes the unusual stock option activity, as well as a calculator, which goes through so you can plug in your calculator, puts, calls, various strike prices, and on a daily basis they have emails coming out on unusual stock option activity and also unusual index option activity. Apart from that, you can drop down into that and to have a look at on a stock basis or an index basis of where the activity has been. Okay, so on the other side, it's writing a put option. Now, there is the saying in the options market, the way to make money in options is to sell puts. Okay, the process of writing a put option is selling a contract to an investor. The investor, if invested in the stock, has purchased the right to sell the stock under the put option. The rights will be exercised if the stock price falls below the strike price. Thus, the investor is probably using the put option as part of a risk management strategy. So here's a practical guide on how to write a put option. First off, to start, select a stock within your investment universe that, based on your valuation for the stock, you set a target price where you would be prepared to purchase the stock. Thus, an understanding of the stock's valuation is absolutely key. Other important issues include the current trading range for the stock and any upcoming upcoming events or news such as earnings that could impact the stock's price. The put option's expiration date stated in the contract means it expires on this date independent of the strike price. The holder will either exercise the option and sell you the stock, or the contract expires worthless, and as the writer of the put option, you keep the premium. Now, cash must be available to purchase the stock when exercised to cover this risk. The broker needs the cash to be available. There could be the requirement that the cash is held on an account over the option's term. Thus, after selling or writing the put option, there is the need to monitor the stock price and the option contract to determine if the investor will exercise the option. If the stock price falls below the strike price or on or before expiration date for an American option, the holder of the option will likely sell the stock to you at the strike price. Okay, so let's take a look at the options market and why it works. First off, let's look at a put option. So, an investor buys a put option. They are essentially hedging the fact that the underlying stock price could fall below the strike price of the put option. If the stock price falls below the strike price, the investor can exercise the put option. This involves selling the stock at the strike price. Okay, so let's take a quick example of a put option. An investor buys a put option on AA stock with a strike price of $100 and a 3-month expiration. If the stock price falls below $8 to $80 before the expiration date with an American option, the investor can exercise the option and sell the stock at $100. If the stock price remains above the strike price of $100, the put option expires worthless. Okay, so let's move on to call options. When an investor purchases a call option, they are essentially betting that the underlying stock price will rise above the option's strike price before the expiration date. If the stock price rises above the strike price, the investor can exercise the option and purchase the stock at the lower strike price. The investor then could make a profit by selling the stock at the higher market price. So let's take an example, a call option. Now, an investor buys a call option on YYY stock with a $100 strike price and a 3-month expiration date. If the stock price rises to $120 before the option expires in an American option, the investor can exercise the option and purchase the stock at $100. This allows them to profit by selling the stock immediately at the higher market price of $120. Okay, so there are commonplace use cases for options. High-growth industries such as the tech industry commonly use call options as part of their compensation package to incentivize employees. Okay, the Greeks. The Greeks are measures for the sensitivity of the option price to various parameters such as volatility or the price of the underlying stock. They are used to analyze an option portfolio and also the sensitivities of an individual option. In this way, investors adjust the hedge position and manage risk. The option Greeks are delta, gamma, vega, theta, and rho. Remember the roles and sensitivities by this table. A quick review of the Greek tables. So delta, the change in the delta depends on the change in the option price, and that is due to the change in the stock price. The gamma is due to the change in the delta, and that also depends on the change in the stock price. Vega, the change in the option price, and that is due to volatility. Theta, change in the option price, and that is due to time to expiration. Rho, change in the option price, and that is due to interest rates. So if you like these videos, please hit the like and subscribe. It really does help the channel. See you in the next video.